I have a little after 8. Erin will be here shortly, as I know she's en route. Why don't we go ahead and call the meeting to order and welcome everybody. I'd like to welcome our new council representative, Sean Wright, relation. Hope you'll find this informative, and we've got a really good group here that the professionals in their fields, whether retired or presently working, and they've been very good at guiding us and giving us good advice. We'll start off with the minutes from the meeting of the July 15th, 2020 meeting. Are there any corrections? And if not, I'll accept a motion to approve the minutes.
Motion to approve.
Second.
Okay, motion to approve and seconded. All those in favor, vote aye.
Aye.
Any opposed? None. Okay. We'll move on to the third item. Natalka from Chartwell Consulting is going to review the third quarter 2020, November 2020 plan performance, the flash reports, asset allocation, rebalancing recommendations for the defined benefit pension plan. Natalka, it's all yours.
Oh, thank you very much. Good morning, everyone. Thanks so much for providing some time on the agenda for this review and update. I am going to touch on third quarter performance, though it seems quite long ago. And as has been happening all year, much has changed since the end of the third quarter. So I will be providing an update on that as well. I will, when it comes to referencing the plan-specific performance, guide you to pages in the executive summary section of the performance reports that I sent out. And please, if you have any questions, please ask as I go along, or if you want to wait to the end, whichever is most convenient for you. So let's take a quick look back at the third quarter. The third quarter was a strong one for equity markets. Markets continued to recover from a very weak first quarter of performance that was brought on by the COVID virus and the global pandemic and the resulting shutdowns. In the third quarter, we saw a number of continuations of the same trends in stock markets, and that being that large cap stocks outperformed small cap stocks. The S&P 500 for the quarter was up 8.9%. Mid caps were up 7.5%, and small caps were the laggards, up 5%. Also, the growth style of stock management continued to significantly outpace value, and U.S. markets, outperformed developed international markets, which rose 5% for the quarter, 4.8%. The top honors in the third quarter in the equity markets were taken by emerging markets, however. They gained 9.6%. They benefited from a slow global recovery. If we believe all the news we hear about recovery rates, Asia is coming out of the global pandemic a little bit sooner than Europe and the U.S. at this point in time, so that was beneficial. And the U.S. dollar has been on a weakening trend. So all of those things benefit emerging markets. If we look at what was going on in the bond market in the third quarter, it was decidedly flat. The bellwether Barclays Aggregate Index was up 0.6%, and the best performing sectors in the bond market continued to be high yield bonds, which recovered strongly. They were hit the hardest in the fixed income area in the first quarter. The high yield bonds were up 4.3% in the quarter. Investment grade corporate bonds were up to 1.5%, and TIPS were up 2.5%. Otherwise, government bonds and mortgages were pretty much flat. up 0.2 and 0.1% respectively. There wasn't really a lot of movement in interest rates in the third quarter. They dropped slightly from 0.7% to 0.68%. I think if you are listening to sort of financial news today, the 10-year is up to 0.94% as of yesterday's close. So there's, since the end of the third quarter, there's been a lot of action in the fixed income markets, and a lot of that has been precipitated by the rise in interest rates. As I mentioned, the U.S. dollar weakened versus most currencies in the third quarter, so that did set up emerging markets and provided support to even developed markets. Real assets posted mixed results in the third quarter. The natural resource index fell 9.6% as a lot of economic data was suggesting that there is going to be a slow and uneven recovery. And at the end of the third quarter, oil was $40.95 a barrel. And again, as of yesterday's close, oil was up to 47.64, like $47.64 or so. So oil prices have risen, and as we review November results, we'll see that natural resources has responded accordingly. Global REITs were up 2.6%, and they outpaced U.S.-only REITs in the third quarter, which gained 0.8%. So again, it was a good quarter for equity and risk-on investments in the third quarter, and it was very flat and slightly challenging still for bonds as well as real assets. Now, at the end of the third quarter, in the month of September, we did see some changes in trends. In fact, we, when at Chartwell Review, our quarterly newsletter in the third quarter, the theme of it, or the topic, was changing of the guard. And in this case, we were not necessarily referring to the presidential election that was upcoming, although that sort of fits the theme as well. But we felt that we were beginning to see in the market perhaps a rotation in some of the trends that have been entrenched for the past 2 or 3 years. And those included the outperformance of large cap stocks over small cap stocks. We began to see that change in September. We began to see value as a style across all capitalization ranges outperforming growth, and that trend has continued right through December. We also began to see international markets led by emerging markets outperforming domestic stocks. And and as I said, these trends continued in October, November, and early here into December. It's still, I guess, early to say that this is, a definitive change in course, and that, we should expect to see these trends continue. I think, there's still a lot of volatility in the market, but there's a lot of supporting both fundamental analysis as well as other catalysts that might support that changing of the guard. And so far, the market has been rotating that way. From Murfreesboro's standpoint, you're positioned for that. You have mid-cap as well as small-cap exposure. You have a balance of growth and value strategies. You have a good blend of international, global, and emerging markets equities. And you also have good exposure to real assets, predominantly through REITs, both global and now U.S., as well as some exposure to commodities and natural resources. Those things, that diversification did not help you very much in the first quarter, as some of those areas were the most impacted by the pandemic and the resulting shutdown of the global economy. As I update performance comments for the markets through November, I think I would summarize November by saying the month of November was a very good year for the markets. And I don't mean to be flippant about that, but you saw double-digit increases across all equity asset classes except for emerging markets, which rose 9.3% for the month, so they lagged a little bit. The top performing segment of equity markets in November was international developed markets, up 15.5%. The Russell 2000 index, which represents small cap stocks in the United States, was also up a very strong 18.4%. It was the strongest monthly performance for that index ever. The large cap stocks were up 11, mid cap stocks were up 14%, and needless to say, the month of November pulled all equity classes, both domestic and international, into positive territory year to date. Year to date through November, the S&P 500 index is up 14%. Small caps are up 10. Emerging markets are up 10. Global equity markets, so a combination of U.S. and international, are up 11. So we look at year-to-date results through November, and one, suddenly says, what global shutdown? Equity markets have come roaring back. It was also a solid month for fixed income. November was. The aggregate index was up 1%. The high yield market continued to lead the way, up another 4%. And investment grade corporate bonds did well also, up 2.6%. Once again, government bonds and mortgage-backed bonds were the laggards, up 0.3 and 0.1% respectively. The U.S. dollar continued to weaken in November, and that supported international developed and emerging markets. And real assets had a strong month in November. The natural resource index jumped 17% following the price of oil higher. I alluded to that earlier. And the global REIT index advanced 11.8%, and U.S. REITs advanced 12.3%. So it was the third, while the third quarter was very solid from a performance standpoint, October was actually a little bit negative to flat, very mixed results in both bonds and stocks. And but November was just a black ink month across all asset classes. We're hoping that we can hang on here in December. We have seen large cap equity markets sell off a little bit. The S&P was down 4 or 5 days in a row. Small cap stocks continue to outpace large cap stocks in December. We may have a fiscal stimulus package coming out of Congress, today or tomorrow. We have election results sort of confirmed and behind us, and we're sort of moving on in that front. We have good news so far on the vaccine delivery and the initiation of distribution. So there's a solid chance that December the month will finish in positive territory, and we'll hold on to the gains that we experienced through November 30th. Any questions on broad markets before I dive into the how this all impacted your plan's performance?
I don't see any. You can continue.
Okay, so if you turn to page 6, if you'd like to follow along, there we see the results of the total plan performance as well as sort of money movements with flows and investment gains and losses, both for the quarter and on a year-to-date basis. And then you can also, when I start talking about some more individual manager performance, you can find that information on pages 16 to 18. So either place, if you want to follow along with performance commentaries, those page numbers should serve you well. So the plan was up 4% in the third quarter. That lagged your blended target policy index benchmark slightly by 0.5%. You'll see that you're about 2% behind target on a year-to-date basis, and as of September 30th, the plan was still in negative territory, as was the index, down 3.4% versus 1.1%. That was really due primarily to a weak first quarter of performance. You were 1.5% behind target in the first quarter. And the plan since then has been sort of either meeting or within 0.5% of the target indices, so we haven't closed much of that year-to-date performance gap. December may help matters out quite a bit in that regard. For the month of November, the plan was up 8.5%. Versus 9% for the blended target index. It was sort of a notable month for the plan, in addition to it being such a strong month for global markets. The plan posted its largest one-month gain, $11.7 million, and it also finished at its highest market value of $156,200,000. So, very strong absolute and relative performance. On a year-to-date basis, the plan is in positive territory through November 30th, up 3.7%, and the index is up just shy of 6%. So gaining a little bit of ground, but we'd like to see from a relative performance comparison a good finish to the year in December. So where did the strength and weakness come from in your investment program? Your global fixed income team and the real assets team are outpacing their indexes, so they're doing a fine job. And if you will, the performance issues come from domestic and international equity teams. And most specifically there, sort of the weak links in the domestic and international equity teams are Harbor, Mid-Cap Value, and Mid-Cap Value has been the second weakest performing asset class over the last couple of years. Janus Enterprise Fund, which is your mid-cap growth fund. Mid-cap growth has done well this year as an asset class, but Janus's approach to mid-cap growth, they look for more sustainable growth companies versus price momentum growth companies. So their performance results have lagged the index, which is being driven by stocks, a lot of technology stocks, biotech stocks that are, on a very strong run and may or may not have sustainable business models. So some of the more, I guess, what I'll call older technology or consumer cyclical growth stocks have lagged a bit. We did see that changing for both funds, both Harbor Mid-Cap Value and Janus Enterprise significantly outperformed their benchmarks in November. So we hope to see that trend continue. And then on the international side, the Dodge & Cox International Stock Fund has been challenged as well. And they were about 6% behind target in the third quarter. And just to sort of tell you sometimes how quickly and significantly markets can change, in the month of November, they outpaced their benchmark by 7%. So there's still a gap of performance on a year-to-date basis. We are still taking the opportunity to trim Dodge & Cox International stock on strengths when we see it outperforming, and rotating some of those assets into the global equity managers so that you have a more balanced approach to international and global equity. A couple of other comments that I'll make about individual manager performance, and again, you can see all of the individual manager performance on pages 16 through 18, is Pinnacle Equity, which is your largest manager by assets, has done very well this year. They have, they're a core, large cap core to growth manager, and they are, even through September, when the S&P 500 index was the only index that was in positive territory on the equity side year to date, up 5.6%, they were up 6.8% year to date. They were up 10% versus 9% in the third quarter alone. So they have done a very good job in this marketplace, and it's always good when one of your largest managers performs well for the plan. Brandywine large cap, dynamic large cap value has also done very well in relative space. Again, large cap value, though, through year to date, through September 30th, was down 11.6%. Brandywine was down 7.3%. So on a relative basis, they're doing very well, and they had a very good November. It's been a challenged space. So the value exposure, as I mentioned earlier in your plan, has not been helpful so far this year. And also Vanguard Small Cap Growth, which is an index ETF fund that you have, is also, significantly outperforming its index. On the fixed income side, I would say that your real standout manager on a year-to-date basis has been the TCW Total Return Fund, and that through September 30th was up 8.3% versus 6.8% for the aggregate index. One of the reasons why their performance is so, to me, extraordinary this year is that they invest close to 90% of the portfolio is invested in mortgage-backed or asset-backed securities, which have been the lagging sector this year versus corporates. TCW was brought on board to sort of operate alongside Pinnacle Fixed Income, which is predominantly investment-grade corporate bonds. So this way you have both the government, corporate, and mortgage-backed sectors covered quite nicely, but TCW has really navigated its space very well this year. So those are some standouts. And as I mentioned, the real laggards have been Harbor Mid-Cap Value, Janus Enterprise, and Dodge & Cox International Stock, and those three funds were some of the strongest performers in November. So hopefully that we see that trend continue. On page 14 of your executive summaries, we show you the manager watch list status. So these are managers that if they've underperformed their benchmark index for 3 quarters in a row, we put them on watch list status. We make sure that we reach out to the fund management team at least once a month to see, how they're addressing performance issues. And the 3 funds that I have mentioned as being the laggards this year are funds that are on the performance watch list. And as I mentioned, one of the things that we're doing with Dodge & Cox, because they were your largest international manager, is over the course of the last year, we have been trimming them opportunistically and adding to your global equity managers, which have done quite well for you. And your emerging markets manager is also doing well in a challenged space. So we think that your international equity team is really in good shape. Your domestic equity managers are in good shape, except for some near-term weakness from your mid-cap managers. So hopefully the changing of the guard that we're seeing will benefit those managers. I will just take a couple of minutes here to remind the committee that in August, there were some new managers added to the plan. You added 2 dedicated U.S. REIT fund managers, Cohen & Steers and Principal Real Estate Securities. Both of them are off to a good start. Their third quarter performance topped their indices. Cohen & Steers for the third quarter was up 3.5%, and Principal was up 2.1%. That's a partial quarter return because you were invested in them July 27th, the start of the investment period. So they got off to a good start. Now, real estate has been an area that has been challenged this year because of the shutdown and the pandemic, but your entry has been at a point where the real estate markets are starting to recover. And so you sort of missed in these 2 funds, if you will, the carnage that happened in the first part of the year. But we're brave enough to step into an asset class that was beginning a recovery. I think that, it will continue, and that's not to say there won't be some lumps and bumps in the road, but the real estate market is sort of rotating away from sectors that have been significantly impaired by the global pandemic, such as office space. That's a big question mark, and it's a big sector. And the global pandemic just sort of put more nails in the coffin of malls and certain retail investing. Other retail investing, like big box stores like a Costco or a Sam's or grocery stores, that part of retail has done exceptionally well. So, the U.S. REIT funds, they also invest in data centers, life science buildings, cell towers, all of, storage facilities, last mile storage facilities, all of those sectors have really excelled during the pandemic. And so, we're seeing that in the performance of your U.S. REIT funds. Your global REIT fund, also had a strong third quarter of performance, up 3.6%. But they're on a year-to-date basis, they're down 12, matching the index, and that's where you see the carnage that took place in the first quarter in the real estate market. And you skillfully missed that in the U.S. REIT investments that you made. The other investment that you made right at the end of August, beginning of September, was the Western Credit Opportunity Fund in fixed income. And this is a very dynamic fixed income opportunity fund. It is predominantly high yield and spread product focused funds. There's no emerging market exposure. There's no foreign exchange exposure. It's invested 100% in liquid public market fixed income securities, and it is a very actively traded portfolio. As of the end of November, just to give you some ideas, the portfolio is only invested about 17% in investment-grade bonds. The remainder is in high-yield bonds, in high-yield bank loans, commercial-backed mortgages, and CLOs. When the fund was initially invested in September, to give you an idea of how actively this fund is managed, they invested it very quickly and fully. There was less than 1% of cash in the fund at the end of September. At the end of November, they had 10% in cash. They began trimming some investment grade. They trimmed some high yield. They were putting a little bit more money into CLOs and other spread products. So it's a very opportunistic fixed income portfolio, and it's gotten off to a good start for you. It's up 5% since inception, as Western Asset Management, the fund managers, they would not be surprised if by the end of the first quarter that you saw a further reduction in the portfolio in both high-yield bank loans and investment-grade credit, and more exposure to mortgage-backed securities, both non-agency, CMBS, and I'm losing my train of thought here, and CLOs. So, we're keeping a very close eye on this fund. Even though the fund is only 17% invested in investment grade and about 10% in cash right now, the average credit rating of the fund is BB. So it's not investment grade, but it's just the very high end of high yield. We're happy to see that fund is off to a solid start for you. That's all the comments that I have on performance of the fund. I was going to finish with a few comments on November rebalancing and asset allocation. But if there's any questions on any managers or performance, we can take a moment and address those now.
Natalka, I don't see any. I think you can continue.
Okay, very good. I try to make my comments hopefully to address questions that you might have, but I hope I'm not steamrolling over things too quickly. So I mentioned earlier that the plan had a very strong month of November, up $11.7 million. Plan assets rose from an October value of $144.1 million up to $156.2 million. So very strong, as I said, absolute and relative performance. And also, just for perspective, the plan entered 2020 at $151.8 million. So you're about $5.4 million over that, $5.6 million over where you entered the year. And at the low point, March 31st, the plan had dropped down to $124.3 million. So, very strong recovery in both asset and percentage terms. From an asset allocation standpoint, not surprisingly, your overweight equities, 49.7% versus a 48% target, due to the strong outperformance by equities and also some strong manager performance in your portfolio. And bonds are also overweight, 31.4% versus 28%, and where you're underweight is in real estate. You're at 17% versus a 23% target. We're opportunistically building your exposure in real estate. You know, we made great strides at the end of July and this summer, and you know, hopefully through appreciation and also keeping our eye out for other opportunities in the real estate area or other real asset area, you know, will build that exposure up. Your operational cash, we continue to advise keeping it above target at the top end of your range. Your target is 2%, and you know, we'd like to see it up at 2% or a little bit higher. Just given the market's volatility, we just don't want the plan to ever be in a position to have to liquidate at a low point to meet monthly plan expenses. So our rebalancing directives for this month were focused on trimming some of your overweight U.S. large cap equities, specifically trimming Pinnacle and Brandywine Dynamic Large Cap Value by $500,000 each, and building up more operational cash up to, you know, adding $500,000 there, and also adding to your new U.S. real estate positions, which were a little bit underweight, adding $250,000 to each to Cohen and Steers and Principal. The other small rebalancing move that we recommended, and it's really intra-asset class, is trimming. Well, I want to make sure I get this right, so let me just line this up. Trimming Janus Global Research, trimming the Dodge & Cox International Stock Fund, as I mentioned earlier, by $250,000, and adding to Janus Global Research. So relatively modest moves, but we like the idea of trimming on strength and, you know, perhaps adding to asset classes that are, that we feel are experiencing a bit of a turn and a recovery, which will hopefully continue. Any questions on asset allocation recommendations?
And those trades have already been made for the rebalancing.
Yeah, I think it's really smart.
Yeah.
With the UK poised in 2 weeks to crash out of the EU, I think it's really good we're trimming that Dodge & Cox especially.
Dodge & Cox, their biggest problems this year were exposure to industrials and financials in Europe and in Asia. And those have been hard hit. Both of those segments came roaring back, but as you indicated, depending on how the Brexit situation, unfolds, European financials could potentially take a little bit of a hit again. So, yes, we'll continue to trim Dodge & Cox and equalize them between the Janus and the American funds, global equity funds.
Okay. Any other comments or questions? All right, I don't see any. Natalka, thank you so much for that thorough review, and we look forward to what this quarter brings and the new year.
Absolutely. I am hopeful for December and finishing the year in good stead, and I think that you are well positioned going into 2021.
Thank you so much. Okay, we'll move on to item number 4, Michael Guyton and Matthew Gilliland of Findlay, USI, to present the annual review of the pension plan. Michael, you want to go ahead and get started?
Yes, thank you very much. We appreciate the opportunity to present our annual review. This annual review covers the formal valuation report and the formal GASB report. As you notice, we got a name change here. Findlay joined USI on November 1st, 2020. In the retirement industry, there has been a lot of mergers and acquisitions. Our management was looking for opportunities to acquire companies. The companies were approaching our management to acquire Findlay, and they felt like USI was going to be a good fit for us. The good news is you're going to have the same consulting group. Matt and I working on your plan. No changes in the fees. So it should be no changes at all that you'll see going forward. Be just our normal work as we normally do for the city. I'm going to talk about the valuation of the funding report, and then Matt's going to talk about the GASB report. So on slide 3, actual valuation. We do a valuation every year just to measure the plan's financial position. Like any financial thing, you want to measure and see how well you've done over the period of time. And when we measure the financial position, it's based on the plan provision, the participants in the plan assets, and actual assumptions and funding methods. All 4 of these components impact your funding results on the plan and how well funded the plan is. So underneath the valuation, we use a funding method which provides a systematic approach to fund the benefits underneath the plan. We're using the entry-age normal funding method with the unfunded accrued liability amortized over 40 years. This method was adopted when the state came out with the pension law, and it's in your funding policy as an approach that we would use to fund the plan going forward. Ultimately, the cost of any pension plan is benefits paid, less employee contributions, less investment income. And currently, there's no employee contribution plan, but if you go back in prior to 1998, there were employee contributions to the plan. So on the following slide, we talk about the key actuarial assumptions. If you remember back in 2018, we did an extensive review of all the actuarial assumptions. One of the key assumptions is the investment return. This is one of the driving forces of your costs each year is the investment return assumption. Prior to 2018, the assumption was 7.25. Currently, the assumption is 7%. The salary increase assumption is 4%. Mortality table, we're using the RP 2014 combined mortality table with MP 2019 mortality improvement. And then when we did our study in 2018, we developed new withdrawal rates and retirement rates, and also plan expenses would be equal to the prior year's expenses. The next slide just shows the withdrawal rates when we did the study. And basically what it's saying, if you have employees with 10 to 15 years of service, we're assuming 2.5% of them would terminate in one particular year. The next slide shows the retirement rates. And we did a lot of discussion on this when we developed these rates back in 2018. Because we're seeing trends that people are working longer. Okay. As you see for general employees, we see that we're assuming they could work as long to age 70. We're assuming 100% will retire at age 70. Fire and police, we see that retirement is a little bit earlier. At 65, we assume 100% would retire at between 65 and 66. For the assets, we use an asset valuation method, which is a smoothing method, where we only recognize 20% of the gains and losses each year. And if you go to the next slide, you can see what happens when you use a smoothing method. The blue line is the actuarial value of assets. And you see how smooth that blue line is compared to the orange line, which is the market value. By using the actual asset value, it helps smooth out your annual contributions to the plan. If you use the market value, you would see you have up and downs, which would impact your funding from year to year. On the next slide, we see the asset return. from 2010 to 2020. The blue line shows the market return, and the orange line shows the actuarial asset return. And you see it's very volatile over that time period. Remember, our goal is to have a return around 7%. The current year, on an actual asset value basis, the return was 4.17%. When you don't make the expected return of 7%, that impacts your funding for the current year, which will increase it because you have not performed as we had anticipated. Okay. Any questions so far?
I don't see any, Michael.
Okay. All right. Just stop me if you have questions.
Okay.
On the following slide, we see a historical summary. As you know, the plan was closed in 2010. So you see the number of employees. If you look in the far right-hand column, 7118, you had 591 employees that were participating in the plan. And you see in just a 2-year period that 591 has decreased down to 529 active participants as of 7/1/2020. You see the payroll there has, it was 34 million in 7/1/2018, has decreased to 33.5 million in 7/1/20. Average salary increases has increased some. Back in 2019, or that period ending in 2019, there were some adjusted pay for the employees of the city, which kind of increased the compensation for the employees. We should probably continue to see that total cover payroll decrease in the future. Since the plan is closed, as we anticipate, the average age is going to continue to increase. Average past service will increase. And you see the retired participants have increased from 274 in 2018 to 323. And deferred vested are participants who have terminated employment with the city are entitled to future benefits. That has stayed pretty constant at this time. Moving on to the next slide, you see present value of benefits. Based on the actuarial assumptions and projecting forward what benefits will be in the future and discounting them back, the string of payments, we come up with the present value of benefits. As you see at 2020, the present value of benefits exceeds $200,000. And it's made up of 3 components. You have your assets, which cover part of the liability. You have your unfunded liability, and then you have your present value of future normal costs, which represents the additional increase in benefits for your active employees looking into the future. The following slide shows the historical funding ratio. The blue line is a liability, the orange line is the actual asset value, and the gray line is your funded ratio. As you see there, your funded ratio over that time period from 2011 to 2020 has always been above 80% funded. Got as high as over 90% in 2015, 2016. And you see the drop in 2018 is due to a combination of the change of assumptions, dropping the discount rate to from 7.25% to 7%. The measurement of liabilities would go up, and then it kind of leveled off after that, as you see, for 2019 and 20, you're right at slightly above 80% funded. On the following slide, we talk about the unfunded accrued liability. This is one of the components that come as part of your funding requirements for the plan. Each year we measure your accrued liability. That's the liabilities that have accumulated to date. As of July 1st, 2020 was $184 million. Your asset value was $150,000. So your unfunded was $34. And when you amortize it over 21 years, the payment becomes $2.9 million. Now what happens, and we'll see this on the following couple of slides forward, this amortization, every year we're reducing that amortization by 1 year. So if your assets do not earn the assumed assumption of 7%, And if your liabilities grow higher because the salary increase is greater than what we assume, you'll see that spread of the amortization payment will will change in the future. The next slide shows all the components for your actually determined contribution. The 7/1/2020 valuation determines the actually determined contribution for the following fiscal year. This way you can budget for it in advance. So here again you see the components. Amortization unfunded, $2.9 million. Normal cost is 2.7, which represents the active participant anticipated cost for the benefits that are occurring in the current year. Plan expenses of $379,000. Interest, assuming a middle year payment of $209,000, for a total annual funding level of $6,284,000, or an actually determined contribution rate of 18.73%. The 18.73% will be the factor that you would apply to the compensation of your active employees for the time period 2021 to 2022. On the next page, you see a graph of your annual contribution. If you go back in 2012, we had made an amendment to the plan where the death benefits, which was an insurance premium, was being paid out of the plan, was switched to be paid out of general funds. That's why you see the gray bar is no longer there after 2010 and 11. And you see the components are basically the normal cost and the amortization piece. So on the following side, you see the historical components of the actually determined contribution. In 2018, you look at the column labeled 2018, you see the amortization non-funded accrued liability increased $2.1 million. That reflects the change in the assumption in 2018. 2019, you see another jump there. Part of that jump was due to unusual pay increases during the prior period. And 2020, you see the amortization has increased even more. That's because the return on assets was not as much as we anticipated. The normal cost, as we continue in the future, you see 2019, we show $2.8 million. It dropped to 2.7. We should see the normal cost continue to decrease because that's based on your active employees, and that population is going to continue to decrease in the future. You see your plan expenses on the third line there going across, staying around the $350,000 range, your interest cost, and then you see your total contribution on the bottom in a dollar amounts. I went from $4.4 million to $5.5 in 2018, up to $6.2 million in 2020. Any questions so far? Okay. So, what caused the changes for the actual determined contribution? So we said it was 18.73% for the actually determined contribution rate. This was a 5.7% increase from the prior year. Salary increases were lower than anticipated in the prior year, which decreased it by 5.6. The actual asset return was 4.17%, which was less than the assumed 7% assumption, which increased it by 6.5%. And then we had some demographic gains that decreased the ADC by 4.9%. So those are kind of the components that impact the ADC. I know we've been talking about keeping your basis for determining actually determined contribution as a percent of payroll, but at some point we'll probably have to change it to a dollar amount because your active population is just going to get smaller and smaller. But we can face that in the future at some point. And moving on, I'm going to let Matt talk a little bit about pension risk here, and also the GASB results. And GASB is which goes with what is shown on your financial statements, and there are a whole set of different laws that is based on. So I'm going to kind of turn it over to Matt now to talk about the pension risk going forward and the GASB. Matt?
All right, thanks, Michael. So we've had to disclose the pension risks as part of what the actuarial profession has for the actuarial standards of practice for the last few years now. And so it's just a way to give you an idea of what risks the plan may face. One of the biggest risks is the interest rate risk, which is the change in that interest rate or the discount rate, which is based on that long-term rate of return. We don't foresee in the near future, unless there's any change to the portfolio, that that's going to be changed. So there's minimal risk for this plan on the interest rate risk side. The contribution risk is based on the percentage of payroll, and as Michael was discussing, we expect that payroll to decrease as since there are no new entrants and as those actives start to terminate and move into other statuses. So the contribution level, the percentage of payroll, is going to rise as the plan matures. Next is the longevity risk. This plan is going to start increasing the number of participants who are inactive, and so how long those participants live will be a significant impact to the plan as people start to retire. So currently our assumption is based off of the best mortality and mortality improvement scales that we have. So hopefully that's a good assumption, but if there's some reason or another that the participants of this plan live longer or less, then that would impact the plan as well. And the last thing is the demographic risk, and so that is based on a plan experience, and so that's going to be a low risk as long as we're periodically doing these experience studies, which the last one we did in 2018. And I believe our process is to do that roughly every 5 years for the plan, just to make sure that our experience is in line with our assumptions and we're not getting any large gains or losses in there from those assumptions. Moving on to the GASB 68 slide. The GASB is the Government Accounting Standards Board, and so this is what the plan uses to do their accounting numbers every year. So the first thing is the pension expense, which is what's recognized on your accounting. And this calculation is slightly different than the minimum funding we talked about, that Michael was talking about earlier, but it is based on the inter-age normal funded method. The valuation date and the measurement date for accounting purposes is lagging by a year. So the valuation date and measurement date are on June 30 of 2019. Whereas we're reporting this on June 30 of 2020. So there's a 1-year lag in reporting. Moving to the next slide, some terminology. There's planned fiduciary net position, which is the market value of assets as of the measurement date, so the 6/30/2019. So the plan was $144.1 million. And then there's the total pension liability, which is the accrued liability, the actual liability that participants have currently accrued in the plan at that measurement date. So for this year, it's reported at $179.4 million. And then below that is the total pension liability, which is your unfunded, the unfunded amount, the amount that the market value of assets does not cover the actual accrued liability. So that unfunded amount for this reporting period is $35.3 million. And one thing to note is for accounting purposes, for the GASB 68, we use the market value, so it is not smooth like it was done when we did the funding review. Moving on to the next slide is some sensitivities as to what would happen if we changed the discount rate. So for some reason we needed to decrease or increase that discount rate to reflect the long-term rate of return, how it would impact that unfunded liability for the accounting purposes. You can see an increase would give you a benefit and decrease that unfunded by about $20 million if we increase it by 1%. And if we decrease it by 1%, then that would increase the unfunded liability. So it would increase the liability, which would give you an increase of about $24 million. And we don't see any reason to change that at the moment. We think that the assumption is good with the portfolio mix, so there wouldn't be any reason to change that. But if we were to discuss a change, this is what potentially could happen. Moving on to the next slide, we can see the year-over-year change in all of the items. We've got the balance as of 6/30/2018 at the top there for the liability, the assets, and then the unfunded liability in each of those columns. And at the bottom, we've got the final amount. And then the items that move through each one of them are service costs, which is accruals for participants during the year as they earn another year of service or as their pay is expected to change. That will change their benefits, and it will give them a slightly higher benefit, and that will increase the liability by about $2.8 million. Then there's interest cost on the liability, which is the biggest impact on the liability, of $11.7 million there. And then you move down, we've got the gain losses for the year. We had some losses of about 2.8 on the liabilities. And then there's contributions, which go straight into the assets. And so it's a negative on the unfunded liability there. And then moving down to the expected investment return, what we were expecting to get for the year was 9.6. And below that one is the difference between the expected and actual. So we were slightly under what we expected by about $2.3 million for the year. And so those flow in into that asset bucket. And then below that is the actual benefits paid for contributions during the year. And those come out of the assets and out of liabilities. And finally are the administrative expenses, which decrease the assets. And that gets you your total change. And so the year-over-year change on your unfunded position, it increased by $6 million and got you to a total of $35.3 million unfunded at the end. Moving on to the next slide, we're going to talk about the pension expense, which is what's recognized on your accounting reports. And that has several components, some of which we just discussed, like the service cost is the accruals, the participant accruals during the year. The interest, which is the interest on the liability and service costs, and subtracting out benefit payments that happen during the year. And finally, and then next is the projected investment earnings. So we're going to assume that it's going to make the 7% and put that into your pension expense. Below that is the amortization of experience. So that's the demographic experience. And any gains or losses on that demographic experience will be amortized over the future working lifetime of participants in the plan. And we also amortize any gains or losses on the investment income. So it's differences between what we expected the investment earnings to be and what they actually were. And finally, are the pension administrative expenses that are added into the pension expense. So the next slide shows how this played out for the year ending 6/30/2020. We had the service cost of $2.8 million, the interest cost of $11.7, and then we're backing out what we expect of the $9.6 million for assets to come in investment return. And then we're recognizing some current year economic gain losses and investment losses. They're that $0.7 million and $0.5 million. And then below that is recognition of what it says, deferred inflows and outflows of resources. So that's recognition of prior gains and losses. And so the economic demographic gains and losses that we're recognizing from prior years that amortize them out is $0.3 million. The investment losses that we're recognizing there are $3.2 million. And then our change in assumptions from a few years ago, we're still recognizing some of that at $1 million. And then finally, the plan expenses of about $0.4 million gets the total pension expense for the year of $11.1 million. We can dig into the gains and losses a little bit more on the next slide. It shows the deferred outflows of resources, which are those are losses that are different than what we expected, and the inflows are gains different than what we expected. And so you've got your totals here by individual component, one being your actual experience, that's your demographic experience, gains and losses. The next one being your earnings, gains and losses. And then that change in assumption, we decreased that long-term rate of return. And so that was a loss there. And then contributions made subsequent to the measurement date are also put in. And so it gets you your total outflows and inflows, which are gains and losses. And the next slide shows how we expect to recognize those in future years. And so for 2021, we've got some gains and losses on those outflows and inflows, and it will hit your reporting to where you'll report about $3.7 million recognized on your accounting expense, on your pension expense for 2021. And then you can see it kind of changes year over year. 2022, we're expecting 1.3. 2023, we'll recognize 2.4. And then 2024, roughly $2 million. And that's as far out as we're projecting because our longest amortization period right now is 5 years. And so as future gains or losses come in, they'll change this slightly. But if we meet our expectation, this is currently what we would expect to recognize in future years. And then the next slide shows the actual deferred inflows and outflows from every year and how they're amortized. So most of these were on last year's report. If they've got year established 2020, those are ones that we have added to this for this year. And so I'll direct you to the first one, 2020, that first line where it says differences between expected and actual experience. We had a loss of $2.8 million that was recognized from that actual experience. And so that's going to be recognized over 4 years, which is the future working lifetime. And you'll recognize about $0.7 million a year for that. And then if we move down, there's net differences between projected and actual earnings that was established in 2020. And that was about $2.3 million. That was the $2.3 million difference between what we expected and the actual earnings that we discussed earlier. And that's amortized over a 5-year period, which will increase your amount every year by about $0.5 million. And all the other ones are bases that were established from prior years and differences from prior years. And then the final slide has the schedule of contributions, which is similar to what Michael showed earlier with the funding report presentation part. And it's roughly stayed, between $4 and $5 million a year. And the contribution as a percentage of payroll for accounting purposes has been 12.3 and moved up to 12.8. But as Michael discussed, the 2020 number has jumped up to about 18%. So that will be on next year's report for the accounting purposes. And that's all I have. If there are any questions?
Okay, are there any questions? Basically, the front half of the report helps the city know what we have to pay into our plan every year, which then gets invested. The back half of the report is the numbers we use in our annual audit report. So that's the difference in what was just gone over and how we use it. Okay, I don't see any questions. Any other business that you know of, Chris, or anybody who would like to bring before the committee? If not, we'll wrap this up. Thank you for your service. This has been a crazy year, and we appreciate your input to help make our investments and this plan go smoothly. Y'all have a Merry Christmas. We're adjourned.
Thanks,
All right, thank you very much.
Happy
you.
holidays, all.
Thank you.